right, without any further ado, let's get back to the money show then. And as I told you, today's topic is going to be all about US-focused mutual funds or international mutual funds. The reason why we want to talk about this is because they really have outperformed in the year 2019. And to give us a snapshot of what sort of returns they've delivered, we have with us Karanya Rao. Hi, Karanya.
Well, Mubina, you correctly said very good returns delivered by all the US-based mutual funds, especially in a market that is looking so bleak, so full of uncertainties and so much volatility. If you look at the top ones, I pointed out for our viewers, I've picked out for our viewers. Franklin India Feeder, Franklin US Opportunities Fund, 26% returns, 26.2% to be exact, followed by a Motilal Oswal Nasdaq 100 ETF fund. That one has also yielded returns in the excess of 20%, 23% to be exact. There's a Reliance US Equity Opportunities with 21.3%, ICICI Prudential US Blue Chip Equity Fund, which has yielded returns of almost 20%, 17%, so almost there. Not bad really in terms of quantum of returns there as well. A Kotak US Equity 14.4% and a DSP US Equity Fund, which has yielded close to 14% returns. So clearly, as we told to our viewers as well at the start of the show, they have actually outperformed.
Okay, all right, Karanya, thanks a lot for that. I think we felt a little bit of a disturbance right there. But yeah, the proof was in the pudding, really. You did see how the US mutual funds have really done well. US-focused mutual funds, of course, do remember that there are focused mutual funds for Europe, etc. as well. US is just one option. But yeah, we thought we'll talk about this trend because, well, 20%, 26%, I think it's too much of an ask in 2019 when the Indian markets have really had a tough time. So let's talk about this a bit more with Harshvardhan Roongta. He is, of course, with Roongta Securities. He joins us very often on the show. Harsh, absolute pleasure having you with us. And, we did identify this trend, right? US equity funds, 26%, 23%, and that too at a time when the Indian markets are not looking good. So it certainly is quite a tempting proposition. So first, educate our viewers a little bit. I mean, for all those who are just introduced to the world of mutual funds, what exactly are US-focused mutual funds? Are all the stocks that fund owns all listed in the United States? Nothing here?
Yes, so absolutely. So we're talking about a scenario wherein if you're investing in any mutual fund scheme, let's just first understand the domestic Indian-oriented schemes. So when you're investing in a mutual fund, what you're effectively doing is you're owning shares of the Indian-listed companies.
Right.
Now, some of these schemes which are primarily responsible for investing only in Indian equities do sometimes even hold international equities. So there are one or two schemes which have a small portion which will invest into international equities as well. However, now what we're talking about is dedicated international funds, which means the stocks that they will own will all be either a US focused, which is the topic today, or else it could be even be European concentrated, it could be a thematic fund, it could be on different, they could have designed the product on different themes. The question is, if you're talking about the US focused funds, now the investment that you do will be in Indian rupees. Just like you're doing a regular investment in any regular mutual fund, the fund house ineffectively will be investing into US stocks. So that's essentially the structure. So you do not have to really go through the RBI permissions and all that bit. Even the, you don't even need the LRS. It doesn't even fall under the LRS scheme of $250,000 per year. So this is not even under that limit. So this is over and above that limit, which you can invest into.
So does it come under foreign assets, as you call it that? Because effectively, if I'm owning, US shares, does it come under foreign assets?
No, not really. That is exactly what I mentioned. So it doesn't even fall under the liberalized remittance scheme that we're talking. We're not even talking about it falling under the LRS. So it is just like a regular mutual fund investment that you're doing. Just that the underlying investment is into stocks listed in the United States.
So don't be fooled by the word US that may be appearing in the names of a lot of these funds. It's just basically as simple as you buying a regular equity mutual fund. It's just that this mutual fund invests in US shares. So Harsh, of course, now I, sitting in India, may not be knowing much about US equity markets and how they function. So if I want to decide that, hey, I've got like a couple of domestic mutual funds, I would like to add some diversification by putting in a US mutual fund or a European focused mutual fund, is there any criteria I should look at when selecting a fund then?
Okay, so the first step is, why would somebody invest into these US focused funds?
Okay.
So returns, what the returns have been in the last 1 year or in the calendar year 2019 is not really the criteria to pick those funds.
Yeah.
So let's just understand what are these funds about. So the first and foremost, that when you're investing into these schemes, so you're getting a benefit of geographical diversification. So you're investing your money all the while in India. Now if you're putting a small portion of your money, say probably 10% or maximum 20%, if you're putting into international funds, you're ineffectively getting geographical diversification. There are different governments, different economies, so you take exposure to that as well. The other part is that there are few companies which are global giants, but they're not listed in India. So take for example Google, take for example Amazon's, these are common names, I'm taking these names. But these are the companies, even if you wish to be shareholders of, you cannot really buy shares because they're not listed in India. So through these funds, you also take exposure to the companies like those. Then there are certain sectors which are not even listed in India. So you will not have any company which works in the aerospace technologies. While in the US it's a very developed market in that sense. So if you want to invest into companies like those, you will get exposure through these US focused funds. So these are some of the benefits that you will have. But besides this, there is a foreign exchange benefit. So if you believe that the dollar is going to appreciate every year by a certain percentage points, when you invest in these schemes, you also get the benefit of dollar appreciating. So, and it could even work the other way around. So if the dollar, if the rupee appreciates, then you'll have even negative returns on that extent.
It could happen, of course.
Yeah, so then these are essentially the importance and the benefits of investing into international funds. Added to this is the convenience that we're talking about. So you don't have to go to RBI for special permissions, you do not have to do any of those things. You just regularly invest in Indian rupees. So not that you also have to invest in foreign exchange, you don't have to invest in US
you don't need
dollars.
to do all that, buy dollars and etc.
Exactly. So you are investing, you can do an SIP in these schemes just like you're doing a regular investment. So it will get debited from your bank account and all that bit is taken care of. So it's a very convenient way of going about it. Now your question about can
how
we
to
track,
choose one,
how do you track the US economy? Of course you can't do it. So that is why you're restricting yourself to not investing 100% of your money into international markets, but you're restricting it to about 10 or maximum 20%. So there could be some of these benefits that you can also get at the same time.
Okay, all right. So basically, it's a good way to diversify your portfolio, not essentially what we say, concentrate it all in one basket, etc. It's a good way. I'm sure there are disadvantages as well. What are those versus a domestic MF?
Yeah, so these are the advantages that we spoke about. So let's just understand what are a few disadvantages. One is, of course, as you mentioned, that being in India, it's not our job to track international markets. We're not fund managers in that sense. So an investor may not be a fund manager. So, while we are finding it difficult to even track our own economy, I mean, going ahead and, talking about tracking the economic developments in US may be far difficult to do so. The other factor is, of course, we're talking about the linkage to dollar. So, say for us, for a reason that dollar has appreciated by 5% and the US economy, the market over there has gone down by 5%. Okay, so ineffectively you will get no returns at all.
Zero,
On the other way around, I mean, even if the US markets have gone up by 5% or 10%, and if your dollar has depreciated by 5%, that gives you a net effect of no returns again. So these are a few things, because it is not only the economic development, it is also linked to the foreign exchange, the currency risk as well. Now the third and the most effective disadvantage, if I may have to say so, is the tax treatment, because these schemes are treated as debt funds. So they're not equity schemes in that sense. Though you're holding shares, you're holding equities of companies, but from a taxation perspective, being international funds on which there is no STT paid, these are considered as debt schemes. So if your holding period is less than 3 years, whatever gains you have made will be taxed as per short-term capital gains, which is as per your tax slab. So if you're on a 30% tax bracket, you pay 30%. And in case it's a long-term capital gains, holding period more than 3 years, then you have a 20% taxation with indexation benefit, of course. So there are two ways to go about investing. So now you know the advantages and the disadvantages. So there are two types of schemes that are being offered. The first one being like a feeder fund. It's a very simple feeder fund. So what happens is, like a Franklin India US Opportunities Fund is a feeder fund.
That's the best performing one in fact.
So it's a feeder fund actually. So what does it simply do? It collects money from Indian investors, and the Indian fund management team does not select the stocks over there. They simply hand this money to the US opportunity funds of Franklin. So Franklin runs the Franklin US division over there. They simply give the money over there. So they manage the money as they are, and the returns are then transgressed down to the investor. Wherein if you take the ICICI approved US blue chip fund, that collects the money in Indian rupees from Indian investors, and the fund management team here invests into stocks directly over
In
there.
US.
So they're not just feeding it into some another fund. They are actively managing that fund. So these are the two different types of schemes that are available. Amongst the feeder category, Franklin is one that you can consider. And if you want to go in for the direct holding of stocks by the Indian team itself, then ICICI approved US blue chip fund.
Okay, all right. So feeder and a regular non-feeder, which is like ICICI, Kotak, I think even Motilal Oswal is a Nasdaq ETF. Okay, so that is is a 360 on basically what exactly are overseas mutual funds. A very important point, they are treated as debt funds, which means that to be it considered as long term, you'll have to hold it for 3 years and not 1 year, which usually is the case, you know, when you're investing in Indian equity markets. That's very important. So it may be a little, it may pinch your pocket a little, but well, I suppose if you do like the advantages and if you want to go for it, that's your option. But folks, we'll kickstart our Ask the Money Show segment, where we give all our viewers an opportunity to get their questions and queries on personal finance answered. So let me open our phone lines. We have our number flashing on the top of your screens, 24990388, and you can always call in, email us on themoneyshow@etnow.tv. But first, I'm going to answer some email questions that we have received up until now. Our very first question is from Mahek Seth. Mahek says, I am a salaried employee and currently have an SIP with a Mirae Assets Management. Should not mention which fund is it, but I would wish to invest in more SIPs. How do I select the right one, and which SIP would you recommend? I suppose one problem with this query is a lack of information, no age given, no amount, no goals. But yeah, there's only Mirae Assets. So firstly, how do you like that as an AMC, and also how would you advise Mehek to go about with her investing journey, you know, depending on her age? If you could share with us a guide basically for each age bracket.
Okay, so in the absence of the specific information, one, of course, Mirae Asset, the mutual fund has been doing very well.
Okay.
So in fact, we see that majority of the funds that they have been into market with, they have beaten their index. So not knowing the scheme that she is invested specifically into, all I can say at this juncture that as an asset management company, Mirae Mutual Fund is a good one, and we don't know the specific scheme, so I don't know which scheme is she invested into. However, the other part of her question is that how should you construct a portfolio?
Yeah.
So we can keep it more generic and from a general understanding perspective. So say an investor wanted to invest at 10,000 rupees per month. So what do you do first? First, what you do is you decide which category, how much money are you going to invest. So you will decide that if I have a 10,000 rupees, ideally what we say is about 50 to 60%. So say around 60% of your money should go into large caps, because these form the core portfolio. So these are the companies which are the largest in the country. They're well established, they're able to weather the economic turbulence in a better manner. So you form a core portfolio with primarily a large caps. So say out of this 10,000 rupees, 60% could go into large caps. Another 20-30% could go into different categories. So within large cap, if you are allocating 60%, half of this could go into a passively managed large cap, and half could go into actively managed. So in this example of 10,000 rupees, you will invest 3,000 rupees in an index fund. It could be the IDFC Nifty fund, and the other 3,000 rupees you invest in an actively managed large cap. So which could be an ICICI approved blue chip fund or an Axis blue chip fund for that matter. Another part of it, then you will allocate about a 20% towards mid caps, because you want some good quality mid caps in your portfolio which help as a kicker to get to boost your returns on an overall portfolio. So you could choose an Axis mid cap fund or an HDFC mid cap opportunities fund in that category. Then the balance amount of say 10 or 20%, whatever is left, you could invest into international funds that we spoke about, or you could choose multi-cap funds in that category. So the idea is, as an investor, you first decide how much you need to put into large caps, mid caps and the other categories, and then pick up a scheme of each category.
But large cap should have the lion's share of your total SIP.
Yes. Why? Because you want to create one core portfolio. You want majority part of your investments to go into the best companies of the country. So large caps are essentially within that category.
Okay, all right. So start with large caps and then mid caps and then a multi cap, or even overseas mutual funds like we have been talking about in the beginning part of the show. that's your choice. But of course, folks, remember that all these decisions can be taken into consideration only after you have considered your age, your income, and other factors as well. This is just a guide with which you could construct your overall portfolio. Please do keep that in your mind. Once again, let me tell our viewers that we are accepting your queries. It's a very short window, so quickly do call in. Okay, very quickly, let's move on and talk about our next query. We have Vinayaka, who has sent in a question. He asks which mutual fund is to be mapped to which goal. Very interesting one. Okay, so he's asking, he has three goals essentially: retirement, child's education, child's marriage. This is, I think, some of the most common goals that most of our viewers as well have. Now, this is his question: a multi-cap fund for retirement, a mid-cap fund for child education, and a small-cap fund for child marriage. Firstly, is this the correct categorization to be done? Because retirement, let's assume that the fact that he's still asking for his child's education, which means that his child may still be studying in school. So that means he still, I think, has a fair amount of time to go for education, marriage, and maybe a little shorter while for retirement. So how would you look at this? I mean, would this be the correct matching to do?
So it is true that many investors try and do this, that if I'm saving for retirement, which kind of funds should I take? Should I take a multi-cap, large cap, all those kind of things. So this is exactly a reflection of that query.
Okay.
So if you just go back to the previous query that we answered, that whenever you're creating a portfolio, it's about how do you divide your money that you're going to invest. So 10,000 rupees divided into large cap, mid caps, multi caps and all that. Here it's slightly different. He's trying to ask, if I have retirement, can I just buy one multi-cap and put it into retirement for my retirement purposes? Well, this is not really the ideal way of going about how to construct a portfolio.
Okay.
What do? Suppose you want to plan for retirement. So in that particular goal itself, you will also have the large, mid and small caps.
Okay.
If you want to plan for children's education, then you might want to go in for a little safer investments. So your large cap allocation will be more maybe, because if the date for school fees comes into picture, then we don't want to really come into a situation wherein then the markets are fluctuating. So what we need to be very careful about, okay, you're investing in equities, but they should be good companies. So it's not really that you go for mid caps for children's education purposes. So you need to be very careful about portfolio construction and not just which category of funds towards each goal.
Divide your money basically.
Absolutely.
And not your goals and
Absolutely.
accordingly the fund. That's essentially. But just refer to our previous guide. Large caps, then mid caps, and then of course your overseas or multi-cap funds. Okay, we have Aditi calling us from Mumbai. Hi Aditi, good evening. What's your question?
Hi, good evening. Basically, my mom is 70-year-old.
Okay.
And in 2017, on her behalf, I have invested in three balanced funds.
Okay.
L&T Equity Hybrid, ABSL Equity Hybrid, and Reliance Equity Hybrid.
Okay.
And for last 2 years, these funds are giving me a return ranging from -2 to +2%.
Okay.
So, I mean, what is the scene? Should I continue? For how long should I continue? At least I should get a FD-like return.
Okay, all right. I think, thank you Aditi for calling in. I'm sure, Harsh, you do want to point out a couple of mistakes made by her, because her mother is 70 years old and just 2 years ago she started investing in these balanced funds. So, and of course, the query that I think a lot of people out there have, Aditi, you're not alone. A lot of people have faced negative returns, in mutual funds in the last 2 years, but mutual funds are for the long haul. So, Harsh, the floor is yours over here.
Well, Aditi, the first thing is, the last part of your query, you said that at least we should get FD kind of returns. So when you're investing in mutual funds, just be very careful about this fact that FDs are a different product altogether, where they have a fixed coupon rate and they will be paying interest on it. Whereas on the other side, when you're investing in mutual funds, they're market linked. Even the equity portion is market linked, and so is the debt portion. So you need to be very careful as to what your expectations in a product is. Secondly, as Mubina said, your mother is 70 years in age. If you're investing in equity or a hybrid product, it is likely to be fluctuating, and last 1 or 2 years have been very painful for the market, and that is why you're seeing a negative return. Even debt schemes have faced a lot of defaults. So it's very natural for you to see these kind of returns wherein you have a -2 or a +2 range. So I think that's kind of returns. I'm not surprised with the expectations or the performance of the scheme. All that I'm concerned about is that you're in a wrong product if you're expecting a fixed deposit kind of returns on these investments. So I think just go back to the floor again, go back to your drawing board rather, and then just think as to what you're doing. If you're not comfortable, if you don't understand this, please you still have a choice to exit right now, and then choose a fixed deposit where a fixed rate of interest will come, and that solves your problem. And come in for your own self into equities or hybrid products for long-term goals that you may have.
Yeah, in fact, I was just going to say that. Like Aditi, I hope you have a mutual fund portfolio for yourself because obviously you're younger and your time horizon as well will be longer, and mutual funds are for individuals with longer term time horizon. So Aditi, I hope you too have a mutual fund portfolio for yourself, and if you do, and if you want us on the Money Show to give it a review or a relook, please do email us on themoneyshow@etnow.tv. Okay, thanks a lot Aditi for calling in. We have Raj Gopalan from Chennai who is calling us now. Good evening, sir. What's your question?
Hi, good evening. This is Raj Gopalan from Chennai.
Good evening, Raj Gopalan.
Yeah, my question is that till last year there was no long-term capital gain tax.
Right.
But, Modi no impose some tax. And listen, last week I was hearing from Nirmala that she was removing.
Yeah.
Still the long-term capital gain tax is there, or they removed it?
Okay, so Harsh, of course, I mean, I'm sure you'll also be able to answer, but it's just the surcharge amount that has actually been removed on LTCG and not LTCG itself.
Yes, so in fact, what Raj Gopalan is in fact asking about, there was some news information saying that long-term capital gains entirely on equity investments are being considered by the Finance Ministry for being completely removed. So that as of today is not the case. I mean, that may be under consideration, but as of today, for sure, there is no such confirmation, and long-term capital gains on equity investments continue to remain at the rate of 10%, with the first 1 lakh being non-taxable.
Okay, all right. So that's just a quick clarification. We just have time for one more caller. We have Rahul who is calling us from Dubai. Hi Rahul, glad to know that we have lots of viewers from Middle East. In fact, this is the third caller we're getting from the Middle East in the last 1 week. Rahul, good afternoon to you and good evening from us. What's your question?
Yeah, my question is, thank you very much for connecting first of all.
Most welcome. Go ahead with your question.
Yeah, my question is that I have been investing in mutual funds from last 4 years, and now my portfolio has ICICI, L&T, SBI, Magnum, Blue Chip Magnum, SBI Magnum. But of late I have also bought DSP Equity Opportunities Fund, DSP Mid Cap Fund, and DSP Natural Resource Energy Funds. All of the three are not performing.
And the earlier ones which you mentioned, they're all in the large cap category?
Yeah, so the earlier which I bought was SBI Magnum Multi Cap Fund, SBI Magnum Global Fund, SBI Blue Chip Fund, L&T Infrastructure. Most of them are performing and I'm getting a return of 8 to 9%.
Okay.
Excluding these three, which I am getting in minus 2, minus 1. Yes.
Okay, and you have a lot of thematic funds as well in your portfolio, because I know he mentioned infrastructure, and I think the last one was even the DSP Natural Resources Fund. Okay, he's mainly concerned with DSP, and again he's looking at it from a return perspective. Harsh, how would you advise Rahul?
So well, as a fund house, of course, there have been some top level management changes at DSP. However, I would say, look at the scheme, the fund management team or the top management in that sense, there may be some kind of changes. There has been some change in terms of who's handling the funds that you're being invested into. But nevertheless, I would still say that keep invested for some more time. Maybe you could review this after say 6 to 8 months, because unfortunately you have markets also being very volatile, at the same time the fund management team changing. So both things put together have kind of affected DSP negatively in the recent times. However, as a fund house, of course, the fundamentals are strong, just that it needs some more time to settle up. So what I would suggest to you is stay invested for at least 6 months from now, and maybe review it after 6 months.
Okay, all right. Just be a bit patient. Yes, there have been some chops and changes in the management, but yeah, hold on for now. Rahul, I hope Harsh has been able to answer your question. And on that note, we're out of time. So Ask the Money Show will have to shut shop right here. Harsh, thank you for so much for joining us as always and answering all the viewer queries. We will take a very short break, but when we come back, we are going to be talking about a new product from the LIC stable, and that's the Jeevan Amar scheme. How does it differ from a regular term insurance or from other insurance policies? That's what we will be discussing when we return.